Good morning, good afternoon. All right, let's give a few minutes and we'll start soon. We'll start. Hey Sam, I hope you're happy now. Everyone should be happy now. We got the rate cut. So we'll talk about it. We'll talk about it. All right. Okay, who else do we have? All right, I guess maybe give a couple of minutes for others to join. Hey Brent, how are you? Brent, is this the and my apologies if my memory is deceiving me. Is this the first time you're joining? Okay, you've been to a couple of them. Yeah. So, all right. Sometimes I get confused with the names. So I just wanted to make sure. Sam, what you're saying, ARK Innovation unloaded 52,000 shares of Palantir at Thursday close. The stock is ARK's seventh biggest holding and has soared 41% in past 3 months. Yeah, it's like more than 100% this year. So Palantir, I think I've been Palantir shareholder for now 3 years. So I have some thoughts around it. So I will share. Yeah, it's almost 125% up this year. So it's okay. I mean, ARK
Hey,
Innovation is an active ETF. So they trade
hey,
in and out.
when you first brought her up, I thought her analysts or her traders knew what they're doing. But since I think they just do things very randomly and they don't know the hell that's going on.
So which is, I think, true for many of the people. We don't know what the hell is going on in a short term. That is my philosophy. Nobody knows anything, what's going to happen in short term. Uh, but despite that, ARK, I mean, I don't like the way they trade. I think they don't invest. They basically they're an active trader, and you get exposure to active trading ETF. If you're not a trader, but you need someone who can actually go in and out of positions, maybe ARKK is one of them. And I think they also sold Roku or something. The price target what was $5,000 for Roku. Crazy, yeah. So I don't have a very favorable opinion for ARK, but that doesn't mean that I don't hold it. Uh, I mean this ETF works well in case of low interest rate environment. So I do have some exposure to this, but uh, but yeah, they're very active. It's a trader ETF. Thoughts on jumbo rate cut? Yeah, we will talk about it. I have thoughts on it came up in a couple of I think one podcast or YouTube. Again, very intelligent people, way more intelligent and more credentialed than me. So I do listen to them. We'll talk about the rate cut, but does Fed even matter? That's a question. So I'm gonna spend some time on that as well. I know. I mean, I talk about macro only when Fed does a rate cut. Now I'm wondering, does Fed even matter? So yes, we will discuss the rate cut. What else? So today, what do I have on my list? So I'm gonna first of all we'll finish the spillover from previous week, which is to complete our discussion. Not complete, but finish the discussion on fallen angels, and I will revisit the India's investing because I learned something more around what's happening from an Indian market perspective. So I want to revisit that. And then, of course, the general market, some new crypto updates, some exciting update. So we'll talk about it. And some charts I have. We're going to discuss that as well. ARK fund sold. Yes, that's what I was saying. It like they unloaded some shares of Roku. Looks like it's not gonna hit 5,000 at the end of 2024. That was their original price target. Looks like ain't happening anymore. Sorry, that was a little sarcastic. Yeah, but just don't invest on, I would say, any fund or any ETF without knowing what that ETF hold. Um, I'll be being surprised more than once. The ETF name says something, and then you go and open up and see the holdings. It might have a different companies that you may not even expect to hold in that ETF. So Aditya says, I've lived in 3 countries and never seen 30-year mortgage products. I wonder how much control Fed has with people sat on such long-term products. First of all, Fed doesn't set your mortgage rate. So yeah, we're probably jumping the gun in talking about what Fed does, but Fed doesn't set up the mortgage rate. And you're right. UK doesn't have 30-year. India doesn't have 30-year. US has 30-year mortgage. And I was surprised to know, one of my families, they are in UK, and they says, you don't even have a fixed rate. I'm like, what do you mean? Or they have like, I think it's kind of a floating rate. So, and then if you prepay the mortgage, one of my colleagues who moved from UK to US, and he wanted to prepay his mortgage, and you have to pay a fine to prepay that mortgage.
Yeah.
Crazy.
Yeah. So every year there's a limit of about 10%. But there are fixed rate products, but there's typically 2-year and 5-year. And the most recent one has been, now they've come up with 10-year products. But I agree. I mean, the Fed doesn't set the mortgage rate, but I mean, they reflect kind of the base rate. So that's what I was referring to.
Yep.
Yeah.
So, okay, what else? Let me see any other comments. Oh, it is. All right, so I guess let's get started. Some folks will join. Oh, where are some of our regulars? I don't see Ramesh Ji, and maybe he'll join a little late. Anyway, I see a new name. Avnish, is this the first time you're joining?
Yes. Good morning, Vivek.
Hey.
Yeah. This is Avnish. I am based out of Bay Area. So I joined the meetup and saw your event. So looking forward to learn something.
Okay, so what have you already been investing in the market? What's
Very,
your general kind of investing?
very minimal, like company-based stocks, and not very. I'm not very familiar with the investment strategies and all. Yeah. So you can say newbie.
Okay. Good thing on the you. I mean, there are so many products. You don't have to be a strategist or have to have a deep knowledge around investing to actually make money out of stock market. Sometimes I feel those who are a little more uh, try to extract extra alpha end up taking the risk that they should not and kind of lose money. Whereas those who are not that aware of the market, but just do basic index investing, outperform those who are intellectually or have a higher IQ for the market. You'll be surprised to know, and I think there are many, at least a couple of studies that I have seen around millionaires in America. You'll be surprised to know that a lot of millionaires, I mean, more than 85% are like first generation millionaire, they have not inherited any wealth. And a big portion of them are actually teachers, blue collar workers who just stack and invest into an ETF or mutual funds when ETFs were not there, but they did it for longer period of time. So I think the better is to focus on increasing the longevity in the market rather than trying to increase the rate of return in any particular year. I've seen many folks, blowing up their account in trying to increase the return percent for a particular year. Anyway, welcome, Avnish.
Thank you.
So the way I do this, I'll basically pick up a topic. We look at what's happening in the market. I do talk about a little bit of macro as well. And then, bring up some charts. If someone wants to talk about options, we do it. Yeah, if you have any questions, feel free, put it in the chat, and we'll move from there.
Yeah, thank you, Vivek.
All right, cool. Okay, I guess so. Let's get going. Welcome, everyone. This is our 248th discussion. Two more, and we'll be hitting 250. So good to be, continuing on this journey of investing, and basically, sharing my thoughts and learning from you all when you ask those intelligent questions or you challenge me, which I love when you challenge my thesis. It makes me as a better investor. So don't think twice before you try to say, hey, you're saying you're bearish on it. These are the points why you are bullish. Or if I'm bullish on something and you are not, bring those up. Everyone have their own blind spots, and I'm sure I have my own. So it's better to have a conflicting view, constructive criticism, not just because you hate me and then you just want to go against me. But yeah, you have a point, bring it up. And no, I think no question is invalid question, right? So feel free to bring up any question. Okay, so like I was saying today, gonna finish our last week topic spillover from last week, which is to look at fallen angels, Starbucks and Intel. I want to look at, and then little bit more update on India as an investment thesis, and then of course general macro. We had a rate cut, so we're going to talk about that. Some charts, some news around the company. What I've also done from this week is, and let's see how it goes. If you guys like it, then I'll probably do it every week. Is just give you one liner on some of the company news that I have read through, and if there is more interest, maybe we can dig deeper, right? So something kind of a news that you can use. Right? So I do read a few newspapers, so if I find something interesting, I do take a note of it, and maybe I'll just bring those one-liners. All right, so with that, let's get started. As always, everything that you see here is only for education. It's not an investment advice. I'm not a financial advisor. I spent most of my life in the tech industry, and not in a financial services. But I'm interested in the markets. Capital markets fascinate me. So this is what I'm focused on. All right, so let's first go through our previous week spillover. So I think we have started a series of discussing fallen angels, means the companies that were once considered great businesses, but have recently fallen on bad times from business perspective or from a stock perspective. So I think in the past we discussed ELF, we discussed, I guess, Nike, we talked about a few more companies. So today I'm going to talk about Intel, right? And Intel has been in news lately. So this week also Intel was in the news, and then I was wondering, oh my God, we should have covered this topic in the previous week, would have been useful. But anyway, it's never too late. So Intel was founded way back in 1968. And I think Intel is a company which basically put Silicon Valley on the world map. Intel Inside was a pretty, I would say, great marketing, branding genius that they did. Reached its peak growth in 1990s, and it stayed longer on the top companies for many decades. Majority more than some of their contemporaries have stayed here. I there was a Fairchild Semiconductor. We don't hear those names anymore. There's a fascinating story about the Intel. The legendary CEO Andy Grove. Only the paranoids survive. I had read this book maybe 20 years ago or more than 20 years ago. And you know, these are like one of those we used to put on the same pedestal like Jack Welch in terms of how to run a company. And I think they need to get back to Andy Grove's style of operating a business in which always be paranoid. Like Amazon says it always day one, and Andy used to say it's only the paranoid survive. Guess Intel became a little um, a less competitive, I would say, a little more laid back, and gave up lot of the market share to the competitors. You become complacent. That's what happens if you keep winning for many decades or many years. You think, oh, good, I figured it out. I'm the king. And then when you become complacent, the competitors basically start to bite on your heels. So looking at the revenue and these are the growth. So look at the revenue growth. I pulled up the data from 1994, almost 30 years worth of data, from growing almost between like mid-teens. The revenue growth is just fallen to the negatives. It haven't been growing much, I would say, since 2012, almost last 10 years. I think it's only one particular year where it hit a more than 10% revenue growth. Margins, similarly, not a doesn't paint a good picture. Gross margins have been declining as well. Sorry, operating margins have been declining as well. Now we are looking at almost 1 to 2% of operating margin. Looking at their gross margin, again on the decline. So have not a great business performance for at least for the last 10, 12 years, right? Things haven't been working out well. If you look at the top semiconductor companies in every decade, 1990 was NEC, 2000 decade it was Intel, 2010 was Intel, 2020 was Intel, 2022 TSMC, and 2024 we know the story. Nvidia is the biggest markup company when it comes to semiconductor, right? And I think it was yesterday evening I was listening to a podcast while coming back home, and there was discussion around AMD versus Intel. AMD is now what, $250 billion company, and Intel is now what, less than $100 billion company, right? So tables have turned, and Nvidia, even forget about it, that's like $2.5 trillion company, right? Yeah. So this is a perfect example of a company, which is like fallen angel. Hasn't last 10, 15 years haven't been really working out. I mean, if you look at the share price of Intel, so business wise hasn't been performing that great. Let's look at how the share prices have done, right? So over last 20 years, we go back, right? I am now where this is 2012. Yeah, I haven't been performing that great either. Let's say, let me go back to, yeah. And this, I'm looking what, 2007 at $27, right? And today Intel is trading at $21. So not been a good, even from a stock perspective also, not been a good performer. So what's been happening with Intel? Intel has been challenged at multiple fronts. On the CPU side, which is where the Intel's core strength was, Intel Inside, it's a CPU which is in your, run all your Windows Windows desktops as well as laptops. It's been challenged by AMD. When it comes to the other one, GPU side, NVIDIA had been a champion on GPU side. I mean, NVIDIA create the whole growth story. The origin of NVIDIA is to have a chip which is specific to graphics. And later on, they realize, oh, you can actually do a lot of a data analysis using the similar chip, same chip. So it became very, it found its more use case in doing data crunching during the whole, big data revolution. And then last 18 months or so, almost 2 years now, since ChatGPT came out, it's all about AI. So you can use NVIDIA chips. This is the best chips to do AI. So NVIDIA has taken over, that market. And then the other business, which is their foundry business, which is they create chips. So far, they've been creating the, manufacturing chips only for their own use. But now, ever since Pat Gelsinger joined as a CEO, he wants to make chips for others as well. And they have a formidable competitor, TSMC, right, on that. So they are being challenged from multiple fronts by some of the biggest players, right? But when it comes to the US, the only positive side which I see is they are the only big player which actually manufacture their own chips. They may not be as great in manufacturing as TSMC, but they are the only manufacturers of a chips. Now, in a perfect world, doesn't really matter because, hey, I can always get the chips from TSMC. We are now globalized economy. If Intel doesn't produce chips, so what? But what COVID has taught us is, hey, best quality at a best cheapest price, which is what we were focused on as a part of our globalization. What COVID taught us was that's not good enough if you can't even get the chips. Right? So securing the supply chain is important because if you have the chips, only then the quality matters. Only then the price matters. If you can't even get the chips, how does it help you if there's a very cheap and out of a greatest quality? You just can't have it. So, and with the geopolitical tensions and the situations going around, within China and Taiwan, we want to, it is becoming strategically important for the countries to have their own supply or to secure the supply of the chips because everything runs on chips, right? So it's like an oxygen for an economy. If you can't get the chips, we won't be hosting this meeting, right? So that's only, I think the biggest factor that's still keeping it alive is, hey, this is the only player. It is of a strategically importance to US, right? So even if it is not the the best player, but it is the only player, right? It's like a one-eyed person in the village of blind. Hey, he's not the perfect one, but okay, at least he's the only one who can see. So, and of course, recently they got a grant from CHIPS Act. I think they got a second installment. And Intel is building 4 plants in US. And that is why the cost of, right now, they're investing all the money back to build these plants. And hence their costs are high and the margins are so low. If Intel plans work out, maybe TSMC and Intel can both, of course, TSMC is the biggest one. Then there is a Samsung. And then Intel, probably all three will survive. And it was, I think, not the last week, but a week prior to it was Intel CEO also had a meeting with Commerce Secretary Gina Raimondo, and kind of impressing upon her that, hey, we should have a US companies buying chips from US manufacturers. And then I think the last week I saw Apple, was it Apple or other company, signed was it Apple or some other? Anyway, another a US company signed. I think it's Amazon. They signed a deal with Intel so that Intel will supply them chips. So again, we cannot depend only on TSMC for something that is must have, right? So that's the thesis, positive thesis around Intel. Looking at the numbers wise, not a great business. And if you look at all the business metrics, there is nothing to write home about. Return on invested capital has been like pretty bad. They have been issuing shares. Operating margin is in like negative, like last 12 months. Even if you look at 3-year average, it is like 9%, 10%. It used to be much better, but now has fallen on bad times. Huge capex investment, 43% of their revenue goes in the capex, and it is because they have to build all those plants. And from a free cash flow generator, now they became a consumer, so no free cash flow, right? So numbers wise, not a high quality business, but it's trading pretty cheap. It's at a $19 stock, right? So can we make the numbers work? So valuation is attractive, right? So if you are a growth investor, right? Hey, I want to invest in the best growing companies. Maybe this is not a company for you. I don't know whether Intel will ever be able to get back to its, the old days of glory where it is growing, 15%, 20%, 30%, right? Growing its revenue. But could it be, a mature company? Growth has probably plateaued, maybe grow 5%, 10%. Could, right? But does that, and at a price point where Intel was trading, that could be a good investment? Yeah, something to look at. So investment consists of, again, I'm probably will be repeating myself. Investment has got two things. One is the business of, and number two is what the price you are paying for that business. A high growth business could be a bad investment if you pay too much, right? We learned these lessons in 2021, Zoom growing crazy, but we paid too much for it, right? Not a growing business could be a good investment if you are paid, you paid very less for it. So from that perspective, hey, could it be a good investment? I think it was 2 or 3 weeks ago, I did tweet that, hey, Intel is now trading at a 70% of its book value. Right? Either the market believes that, even if you close on Intel and sell all its plants, machinery, and all its assets, is going to fetch you 70 cents on a dollar. Right? That's how it was kind of a trading on. Number two is with valuation so low, it could be an acquisition target also. So which we saw this week that there was a news in I think Wall Street or Bloomberg that Broadcom probably had a talks with Intel to, was it Broadcom? Qualcomm. I think probably it's Qualcomm. Held talks with Intel for merger or a takeover, right? Again, the companies haven't confirmed or denied any of these things, which we'll never know unless they make an official announcement. But there is no smoke without fire, so something might be there. Who knows? Because right now it's trading at such a low valuation that it could be a worthy a look from an investment perspective. So with that, so I have been selling puts on Intel, I think over the last 3 or 4 weeks, and fortunately it have worked out. Yesterday again I sold a put at I think $19, and you get 40 cents, 50 cents, which for like 30 days, which is if you really look at it, that's a good amount of a return, right? So, and yeah, so. anything below 20. And again, that's not an investment advice. You should look at your own portfolio and what you want to hold. But I think from my perspective, yeah, below 20, I feel it's a good value for number one, good value for money. But two, I have a low look, what do you call it? The risk is low, right? So I have a margin for error. The risk is low because the stock is already beaten up so much. So that's my thesis on Intel. Questions? Any questions on Intel? Any thoughts on Qualcomm merger? No, I didn't look into it in terms of are the details out in terms of what they're paying for it? I don't think so. I thought there was just a headline or some news item that came in that there's some discussion that happened. Yeah.
They said it should be approved. It's actually, I'm pretty sure it's Qualcomm wanting to buy Intel. But number one, because Qualcomm needs a fab, this is CNET or whatever, CNBC. So it should be approved very fast. And it's a good deal for, it's a good merger. And I don't know. I think this is my own. They should sell off what they don't need. The overlapping, but it should be a fast deal. That's about it.
Okay, I think they have reached out, but I know there are a lot of things that are happening with Intel. So let's talk about recently the changes that Intel has done on in terms of restructuring their business. So they are also looking to spin off the foundry as a separate business, because what's happening with Intel is because of so much investment that they need to do in building up those plants, all of them are showing up in the overall P&L of the Intel as a company, right? One is that the foundry business, another one is the designing of the chips. So it's kind of a dragging down the profitability of the other portion of the business, which is their designing of the chips, right? So there are discussions around maybe spin off the foundry as a separate business and let the foundry go out and raise the capital as a separate business itself. I think I like that idea, because it will also, if Intel is trying to build foundry as a business, it means they need to work with other chip companies who wants to have their chips manufactured. But if you are competing with me, I'm Intel, I make chips. You are AMD, you want chips. Why would you give it to Intel foundry business? Because you might be afraid, guys, if I give it to Intel, why would they not prefer their own internal business over me? But if you make a foundry as a separate business, then hey, everyone is on even keel. If you are a competitor of Intel in a chip business, fine. We have nothing to do with Intel's chip business. We are basically a foundry. We're going to create a chips for everyone. So I think from that perspective, makes sense. And if they really want to grow foundry as a separate business, I think they will have to do it. Just to allay the fear among other chip companies that their secrets won't be leaked to the Intel chip business, or Intel chip business will not get a preferential treatment over them when it comes to the foundry work. So that's one reason. Number two is, of course, the financials become much more financials become separated, so you can look at Intel as a chip design company versus Intel's foundry as a separate business. So I think and now I don't know in terms of when the Qualcomm is looking for, maybe they'll and it also becomes easier if someone wants to buy, right? Maybe they'll just buy the foundry business. Who knows? So that's an interesting discussion that's happening on the Intel boardrooms. I know they recently had a boardroom meeting to talk about the future, and Intel is also looking to raise funds by selling off I think some stake in Altera, as well as there were discussion that they may be offloading some Mobileye, which later on they said they don't want to. But anyway, so there are things happening on Intel. They're trying to restructure the company, because the way it's been working for last 3 years, it ain't gonna work longer. Intel had to cut their dividend, so one portion of the investors are already pissed off with Intel, so they really have to figure out what they want to do. It's one of the biggest success stories of Silicon Valley. I would hate to see it go as like on the same path as Yahoo, but if you're not gonna be competitive, I guess it's only US government which is currently saving it. Right? We can force US chip designers to buy some portion of chips from Intel to just keep it afloat. So Intel CAGR of 0.1 over 20 years. It hasn't been you know, when it comes to the stock, hasn't worked out. Yeah, it probably has given a dividend. So this, I would say, it's not entirely. So we should look at as a total shareholder return, which this chart doesn't show. This only shows the price of the stock. And I don't know how much a dividend yield it used to pay. So right now the yield is 2.29%. This is after they've slashed it. So yeah, probably you made some dividend like whatever 3-4% dividend it used to pay. I don't know how much it used to pay, but yeah, in any case, we haven't made much, including the dividend. If you have stayed with Intel for 20 years, I think the rest of the market, if you look at SPY, has performed much, much, much better. Avnish is saying, heard about Intel's AI strategy can be a game changer for them. I don't know. I mean, what they're talking about AI, so far, NVIDIA is being the leader on AI. I know what Intel is doing is to create chips for Amazon, because at the end of the day, and this is what we, I think, talked about months ago, when if NVIDIA can make like 60% operating margins, like Jeff Bezos used to say, your margin is my opportunity. The other hyperscalers are not going to sit silently and let NVIDIA enjoy those gains. What they've started to do is like Amazon, Google, Microsoft, each one of them have started to design their own chips. Okay. Of course, they'll continue to use NVIDIA where they can't replace it. But I'm sure everyone is trying to figure out, gosh, how do we not depend on NVIDIA and pay through our nose and maybe design our own chips? And in that respect, Amazon has now contracted with Intel to manufacture the chips that Amazon is designing. I mean, on the CPU front, they design Graviton chips. On the AI front, they have a chips Trainium and Infrenium, right? Again, some part of their AI workloads is probably running on the chips designed by Amazon. Some part of it, they also have NVIDIA chips, because if their customers want NVIDIA, then they will give NVIDIA, on their AWS. But each of these companies are looking to not have NVIDIA take away all the profits. From that perspective, Intel's foundry business could benefit from these chip designers looking to get the chips manufactured. Till date, most of them have been going to TSMC or Samsung, right? Because Intel wasn't even manufacturing chips for any external customers. Now Intel is getting into this business, and now with all the geopolitical tension going around, could we see more US companies, chip designer companies, maybe Apple, or no, who knows, going to Intel for their chips? Possible. That will keep Intel afloat. I mean, that's the only saving grace I see. Other than that, I don't know if their own AI chips are that great or not. Someone else can probably pitch in, but I haven't heard of like Intel AI chips performing and on par with NVIDIA, that now the customers are asking, I want Intel AI chips. I don't even know what's the name of Intel AI chips. I know NVIDIA's new model is a is a Blackwell, which will be coming out soon. I don't even know what's Intel AI chips model name is. So foundry side maybe benefit from all this AI revolution. Otherwise, they have a tough job. And so on the mobile side, they lost the game to ARM, right? So that's on Intel. All right, Starbucks. Let's talk about Starbucks, another fallen angel. Despite what is happening to the Starbucks stock, it's still a daily habit for millions of consumers throughout the world. It's got a very strong brand. You need to have your coffee, right? Come what may, you probably cut down on other stuff, but you need to have your daily dose of caffeine, right? That's needed. It's kind of become habit for millions and millions of people across the world. Starbucks has what, almost 30,000 stores, right? And the way they've made it, everyone addicted to Starbucks is they opened so many stores across, in all the, I would say, urban and suburban locations. Sometimes you'll see two Starbucks, in the vicinity of 2 to 3 blocks, right? So we've seen, and that's why, like, almost 30,000 Starbucks. It brought cafe experience to the US. So the most successful CEO and someone probably also think that is the founder, Howard Schultz. He's not actually a founder. He's as much founder of Starbucks as Elon Musk is a founder of Tesla, right? Which means Elon Musk wasn't a founder of Tesla. He joined Tesla and then took over Tesla. Similarly, McDonald's wasn't founded by Ray Kroc. He took over, even though he was the most successful CEO. He made McDonald's what it is. He wasn't a founder. Similarly, Howard Schultz wasn't a founder. I think he was hired as a marketing guy by was it two brothers, I guess, who started Starbucks in Seattle. And then once he went to Europe, he saw what a coffee, how Europeans, enjoy the coffee, right? It's an experience was different. So he brought back, had a discussion, say, hey, we should bring that cafe experience. And those brothers didn't have that vision which Howard Schultz had, and he basically brought the Starbucks brand from them. And the whole idea of Starbucks was to become the third place. Means there are two places which everyone is familiar with. You got a home and you got your office, right? And I think over the last 2 years, there is only one place, right over home, because folks have been working from home, which is now changing. But Starbucks wanted to be the default third place wherein, hey, you want to go and have some discussion, not at home and not in your office, but a third place, you can go and sit in a Starbucks. And that's the experience which, people enjoyed, and people were willing to pay premium for that experience. Right? They sell exorbitant priced coffee, right? But you don't pay for a coffee where you're going to Starbucks. You're paying for that experience of having a third place where you can sit down, you can relax, maybe you can work, right? You can talk with your friend, read a book, read a newspaper, and the overall experience of that environment is why you're willing to shell out $6, $7 for a coffee. Like I said, they had a legendary CEO, Howard Schultz. He's been a CEO 3 times already. 1986 to 2000, 2008 to 2017, 2022 to 2023. And then in 2023, he brought in a new CEO, Lakshman Narasimhan, which was now recently been fired. And I think he'll be back as I don't know. Right now, it's been an interim. They hired a guy from Chipotle as a new CEO. So let's see how that works out. But yeah, Howard has been around. I think he still owns a lot of shares of Starbucks. So still, even though not in an official capacity, but still is one of our biggest shareholders, still command a lot of voice on Starbucks. It's just like you can draw the parallels with the Bob Iger in Disney, right? Keep rotating in and out of Disney, and I think these companies. So this is the issue when the CEO become a much bigger figure in themselves, and the company is identified by the CEO. This is called what and a personnel risk. So there is indeed there's a risk if anything happens to Bob Iger, Disney stock will be impacted. Same cases with Elon Musk. Right? We have a huge personnel risk. It was a growth company, but the sales are not growing much. Kind of saturated in US. Right? Like I said, you walk around, you see a lot of Starbucks around, right? Even in a close vicinity with each other. So what they really need to do is to focus on their expansion outside of US. Right? And right now, the two biggest markets that are growing is, where the consumers, China, not so much over the last 3-4 years, but anyway, China is the second biggest economy in the world. They need to focus on how to grow in India and China. Right? So now in both these cases, India and China, they are facing a tough competition. In China, the local brand Luckin Coffee is basically eating Starbucks lunch. Right? They haven't been able to compete against the prices that at which Luckin Coffee is able to operate. Number two, Starbucks hasn't seen anything beyond coffee. They haven't been able to expand their menu. I mean, their food items are not that great. You don't go to Starbucks because they enjoy those cold sandwiches. No. So the kind of number one, the variety of their offering is limited to the drinks, and hence on the drinks itself, they're trying to bring in new different type of drinks, and they have been they've been offering different choices to the consumers. You can probably customize your drink in 50 different ways. So at some point of a time, I think that's now kind of biting them in their back, because baristas are not able to operate at the same efficiency level as how they were able to do it earlier, because a lot of customizations happening, right? Some point of a time, the companies have to achieve a fine balance between how many SKUs we're gonna keep it versus how much of a volume we're gonna see it through. Like Costco, we don't get many choices in Costco, but they make it up over the volumes. Starbucks give you a lot of choices. Now that's impacting the operational efficiencies. And recently not recently, I think that the COVID, a lot of folks become very accustomed to just order it online and then pick up the drinks on in the store. So that has made the experience worse for the folks who are actually in the store. Because now if you go to a store and order your coffee, you are behind the queue because there are a lot of online mobile orders which are still pending, right? So you wait for 10 minutes, 15 minutes, and what's happening to my coffee? Oh, yeah, you're back in queue. So now you don't get that experience that you were paying up for. And I think the latest CEO, Lakshman, he wanted to fix this operations, but I guess he's been let go anyway. Within 18 months, so he didn't have too much. He wasn't given enough time to fix this. And lastly, inflation in US is taking toll right now. We have seen, I think some of these companies are reporting, I mean, at least Starbucks has reported $7 coffee start to pinch you, because of the inflation is going high and people are, some segments of consumers is struggling in paying their bills. So then $7 for a coffee actually start to hurt. So we'll see. Now they got a new CEO. Let's probably is going to make some changes. So from revenue, and look at the revenue growth has been declining. Operating margin has been pretty stable, right? So it means they've been able to pass on the cost to the consumers so far. So even they have not been growing, but at least they are still able to maintain their margins, right? And people were willing to pay for those margins because of the experience that we were getting. But I don't know if they're gonna willing to pay anymore. So
Vivek,
yeah, go ahead.
well, I was in Shanghai, and this was not in the center of Shanghai, but it's it's fairly close. I guess kind of like where I live now. The suburbs, quote unquote. But at that time, Luckin wasn't having much business, and also Starbucks was almost empty. This was 2017 to 2019,
Mm-hmm.
and so I don't know who the CEO was then, but it wasn't doing too well. Also, Luckin wasn't doing too well then too. But now Luckin has pulled ahead. And also a second point, people are buying $3,000 trifold higher phones. Does that mean that they're spending a lot in China? Because it doesn't make sense. We're hearing that I know how life is in China. It's very difficult. And who would be buying these $2,800 phones?
Yeah, but I think the numbers that were reported by Huawei, like 3 million pre-orders that they got for their trifold phone. So it looks
Yeah,
like,
who would spend so much money?
look, people are spending. And even so I guess some people, those who can afford, they're spending that amount on trifold phone. And again, when it comes to the phones, etc., and when it comes to the coffee, we have a different price points in mind. So coming back to the numbers, so far, if you just look at the financial numbers, Starbucks looks to be a great company. 20%, more than 20% return on invested capital for past 15 year, if you go for a 15-year average. Steady dividend, like almost now paying close to 3% dividend yield, and been buying back shares, operating margin 14%, profit margin 10%, free cash flow, right? Average of free cash flow for last 12 months, 1 year, 3 year, 5 year, like close to $3 billion of a free cash flow. Right? So from a numbers perspective, so far still looks to be a good company. But the question is, what's the story? Numbers tell us what the past has been. And when you and I, we are investing, we're investing for the future. So when I'm trying to invest for the future, I also want to know what's your story for the future, right? Because that's the only thing that you have available for the future is the story, because numbers are not even there. So with the stock trading at 98, right? I was looking, I looked at, got some numbers. I think one of the analysts was sharing these details that they need to recharge their growth to 15%, an operating margin to 15%, to have 93. That, I think when I took this data, it was a $93 shares, right? Now, can Starbucks grow the revenue by 15% and keep operating margin also at a 15% level? They probably almost never had operating margin at 15%, except like say 1 year. Right? On an average, their operating margin has been less than 15%. Their revenue growth, CAGR, has been only like 3-year CAGR is 15%. Otherwise, it's always been less than 10%. Now the question is, it's a history tells us that from a numbers perspective, it's a good business. But when it comes to the future side, unless Brian Nichols does some magic, which I mean he can do it, he had done it with Chipotle, share seems to be fairly priced in. And I think when the stock was trading at 75 before Brian Nichols joined, that time could have made an argument. If we were discussing at that time, we could have made an argument saying, I guess it's a history tells us that's a decent business, and probably it's at a valuation which is not fully priced in or not very high. Maybe there's a case for investment. Now this is a company wherein the business It still looks to be a good business, but what like an investment thesis means also what you're paying up for. I think to looks like probably it's already fairly priced in. So you don't have much margin for error, right? You're all dependent on the growth that Brian Nickel can, achieve in the business. Initial boost because of Brian Nickel joining has already happened from 75. Now it's last week it was 98. I don't know where Starbucks is to this week. SBUX 96. I says already up like 30% since Brian Nickel joined. So did we get all the boost? Maybe. I would want to wait for see what Brian can change in Starbucks. Maybe he'll come and simplify some of the operations, change the menu. Maybe you'll not be able to customize your drink by 50 different choices. Yeah, I don't know why would we even do that. But if we make it a profitable business, bring back the mojo of what the Starbucks was once in terms of an experience that it used to offer. Yeah, then it could turn out to be a good investment. But for now, I'm not buying or being bullish on Starbucks because I think it's fairly priced at this point of a time. So then everything is dependent on the growth that Brian can bring in, and maybe I'll want to give him a time to show me that he can grow the business, or can at least get the operating margins up, if not the revenue. So that's Starbucks. Any other questions? All right, so that's complete our last week spillover. Let's talk about what's happened this week. Fed. So we had one of the most important meetings, FOMC meetings of last 2.5 years. So it was a very boring week personally for myself, because any financial media, you turn on CNBC, all they're talking about is what's Fed gonna do. All the guests, they only have one question: is 50 basis point, 25 basis points, how the market is going to react, what should investors do if Fed does this or Fed does that, right? There was no other topic being discussed. You open a Bloomberg, it's almost like similar thing. I'm like, come on. It became very boring. So I spent a bunch of time in, reading through some memos. Howard Marks has released a new memo, but that memo itself referred to the two old memos, one from 2016, 2019. So I thought, let me first read the old ones before I get to the new one. So yeah, I don't know. The whole media is so enamored by Fed. There was nothing else to discuss on the financial media. So the question that I had, something that we talked about earlier, was, does Fed even matter? Let me read Daryl's comment and I'll come back to this. Do we ever consider the companies Starbucks rely on to source their commodities? I don't know what's the question behind that question. I'm not going to go and audit the supply chain of the companies that I invest in. If that was a question, then I personally don't. I don't have a bandwidth to do that. Or is your question is maybe can we look at those companies as a investment thesis? Then I mean, I don't understand the cocoa space, the coffee beans space. So they're not my area of expertise, but I do that for semiconductor, right? I go back and look which players are in the overall supply chain and invest in that. But when it comes to Starbucks, no, I'm not going to look. I didn't look at their supply chain, and I don't think I'm interested in. All right. So this one came from, I'll give you the summary of, there was a video from Professor Aswa Damodaran. And there was another podcast where I heard about everyone talking about Fed. What does Fed even do? I mean, 20 years ago, I don't think any of the financial media were, or the stock market was so much enamored with what's the Fed gonna announce. I think it's maybe over the last 15, 20 years is wherein, the market is watching what the Fed chairperson is saying, not only what he's saying, in what way they are saying, where they take a pause, did the person wink, did he cough? Oh, come on. So question is, and these are some of the myth that we're going to bust. Fed as a rate setter. Again, I've been guilty of assuming a lot of these things, but that's a beauty, right? You learn more about it, and then you become educated. So Fed as a rate setter. Did we believe that it's the Fed who's setting the rate? And I think before we started the session, we were having discussion around what rates does Fed even set? Does it set our mortgage rate? No. I don't get the rate what our Fed is setting. Does it set the credit card rates? No. Does it set our CD rate? No. T-bills? No. Bonds? Nope. Does it set the rate that on which you can get a business loan? Nope. How about the personal loan? Nope. What rate does evidence set? None of these that you and I have to encounter in our daily lives. Or you as a business, if you're a business owner and you need a loan, as a business, nothing. Fed doesn't set any of these rates. So Fed is not a rate setter. What rate does Fed set? When Fed comes and say, we have reduced by 50 basis points, what rate are those? Those are the rates, which is an overnight bank lending rate. So if one banks borrow from each other or when they borrow from Fed for the overnight, make sure that your balance sheet is strong enough. So your overnight borrowing rate, that's the rate. So unless you're a bank, which I'm assuming you are not, because why would you be in this meeting if you're a bank? We are not impacted. None of this, let me take my word, not that we are not impacted, but none of these, the rates that matter for me are being set by Fed. So Fed is not a rate setter. Right? Is it Fed a rate leader? Right? I guess majority probably you already knew that Fed doesn't set your credit card rates. But I think we think that the rate that Fed set the tone for the rest of the rates. Isn't that the case? Come on, give me yay or nay. Don't we think that the other rates that do impact me follow the rates that are being set by Fed? And hence, I'm very much interested in looking at what Fed has to do. So that's what my opinion also. Let's look at some of the numbers. You look at 3-month T-bill rate, right? Hey, when Fed is reducing the rates, then the T-bills will reduce. Maybe you should take out your money from a T-bills. Right? Going for the last, how many quarters? You can add up all these. Maybe almost 250 quarters. Fed has increased the rate for 96 quarters. And the T-bills rates increased less than 50% of the time of the 96 quarters. So, and Fed has decreased the rates 132, and the T-bill rates actually increased more than 50% of the time. So that's not a clear signal. If Fed is increasing the rates, then I should see that subsequent quarter T-bills rate should increase. But it's the contrary. More than 50% of the time, it actually decreased or didn't change. When the Fed decreased the rates, the 3-month T-bills rate has actually increased a quarter later. Look at 10-year treasuries. You get a similar signals. More than half of the time, the T-bonds, 5-year, 2-year T-bills actually is going in the opposite direction of what Fed is doing. Look at the mortgage rates. Fed has increased their the rates 45 quarters, right? And 1/3 of the time, like it only the mortgage rate increase means 2/3 of the time mortgage rates didn't increase. So how about the fixed deposits, right? The CDs in my bank. And we know if Fed is going to reduce the rates, CD's rate is going to reduce. Fed increase the rates 45% of the time, 70% of the time it doesn't impact you. It only impacts when the Fed actually reduces the rates, because the banks are quick to jump and reduce the rates. But when Fed increase the rates, they're not going to follow Fed. So Fed as a rates leader probably works, I would say it's like a 50, less than 50-50 of the time. So clearly it doesn't say that Fed always, the market always follow what Fed does, the T-bills, treasuries, bonds, etc. More than 50% of the time, it does not. So myth number 2 busted. Fed is not a rate leader. Is Fed a signal sender? This is where the question was, what do you think about 50 basis points? Is Fed sending us some signal? I think it's more than the Fed sending a signal, it's the recipient that matters. If I'm an optimistic person, right, then I will say it's not that the 50 basis points have been cut. The question is, if I'm optimistic, I'm like, shit, looks like Fed is thinking inflation is under control. So, and the labor market is not growing up. So probably, it's a good sign that Fed is cut down the rates by 50 basis points, which is a jumbo rate cut. We never have had that rate cuts outside of a recessionary scenario. Which means I think Fed is thinking the inflation under control, nothing gonna happen, and hence they have cut in a 50 basis points, right? Optimistic scenario, green. Signal that I'm getting from Fed is green. But if I'm a pessimistic, I could take the other side saying, outside of a recessionary scenarios, Fed has never cut 50 basis points. Why are they doing it now? Are they seeing something which I'm not seeing? Maybe economy is bad. Maybe Fed is thinking that if they don't do it, they're gonna plunge US into recession. Red signal for me. Or you could just say it's an election time. It's a politically motivated move. Has nothing to do with economy. So now depending on which side of the political aisle you are, it could be positive or negative, right? That has nothing to do with economy. It's just political games that Fed is playing. So I don't think Fed 50 basis points sending a signal. But if you listen to the financial pundits, some would say it's a good, some would say, oh, it's not good. It tells us more about the person who's interpreting this 50 basis points. It tells us more about that person rather than what is Fed telling us. It is a narrative that you come up with is more important, and which will tell you more about you in terms of how you are positioned and how you will position. With the same 50 basis points, my positioning for the portfolio could be completely opposite to how you want to position your portfolio, depending on which narrative do I identify myself with. So, does Fed sending a signal? No, depending on when you receiving the number or when I receive the number, I could interpret it as red signal or green signal based on what I think about what Fed may be thinking. So clearly may not be a signal sender. Is this a stock market whisperer? And I think this is where everything involved, which impacts us. Don't fight the Fed, right? This is what the street says. Don't fight the Fed. Don't go against the Fed, because market goes the way Fed goes. So looking at the numbers here, Fed increases the interest rates. That should be bad for the markets. But stock market has increased, S&P fund has increased 65% of the time. If Fed decreases the interest rates, almost still, market still increased 65% of the time. So irrespective of whether Fed is increased the interest rates or decrease the interest rate, S&P 500 falling quarter, kind of increased 2/3 of the time. Now, what the heck is Fed doing? I think except the financial crisis, where the Fed and company injected liquidity and had saved the much bigger issue, the role of the Fed outside of those specific areas where we had like 2008 global financial crisis, the 2020 COVID crash. I think in the COVID crash, we can say that the stock market went up in 2020 because of Fed. I think that role was pretty clear. So if you take those quarters out, and those quarters are not included in this numbers, take those quarters out, looks like market doesn't really care about whether Fed increase the interest rate or decrease the interest rate. It just does its own thing. So why should I consider Fed when I'm trying to position my portfolio? Numbers don't support me. 2/3 of the time, market went up, whether Fed has increased the interest rates or whether Fed has decreased the interest rates. Doesn't really matter. So, does Fed tell us, hey, it's how the market will perform? No, it is not a stock market whisperer. Maybe 2020, it was true because we had a crisis and the market went up because the Fed decreased interest rates. Right now, we're not having that crisis. And many a time, probably in all these quarters, we never had this crisis. And then the role and the impact of Fed is been, not clear on the market. So Fed doesn't even, at least the data from a previous quarters doesn't give a clear signal that Fed tells us about where the market is going to go. So what is the Fed? Fed remains, I think the only role that Fed is playing in the overall narrative is the punching bag. Everyone can blame Fed now. We have seen value investors blaming Fed, saying, hey, valuations don't work because there's so much liquidity injected by Fed that everyone is becoming rich on, you can pick up any stock, doesn't matter what the valuation is, doesn't matter what the business is, doesn't matter what the fundamentals are, is going to go up, blame it on Fed. So value investors will blame it on Fed. What else to do? How else do you even explain this? We can blame it on Fed. Yesterday, I was listening to All In podcast, and Chamath Palihapitiya and his Jason Calacanis and David Sachs and all, they were blaming Fed. Then I was like, okay, you smart VCs now also can blame Fed because you're not able to, get your distributions out to your LPs. And the reason that David Sachs was going, Fed injected so much liquidity that the valuations were high, so we invested at a higher valuation. Now we can't get those valuations. We can't distribute the capital back to our investors. But did Fed tell you to invest those companies at such a high valuation? I don't think so. I don't think Fed forced any one of the VC's hands to invest in Nikola in 2021 or invest in FTX while Sam Bankman-Fried was playing video games. It was the greed of the VCs. Or Fed didn't hold my hand to say, hey, you invest in Roku when Roku was a 400 shares. Or invest in Teladoc when Teladoc was $300 share, $200. I bought Teladoc at $250. I feel stupid, but I'm not going to blame Fed. I learned my lesson. Good thing is the position size was okay, so I'm still alive. But I have invested in the stocks in which they are now down 70-80%. I can't blame Fed for it. I was stupid. But now VCs are blaming Fed, saying, they injected liquidity, brought up the price, the valuations high. No, but this is what Fed is now used for. And Elon was blaming Fed last year because they say, interest rates are high, so people can't afford the car. Dude, you make the cars cheaper. Anyway, so the net is, why does Fed even matter? So what's drive these interest rates? Fed doesn't drive it. It's all driven by inflation and our GDP. Right. So Long story short, but this was an eye opener for me as well when you look at these numbers, because the whole media spends so much time talking about Fed, like, and looks like in the long term, really doesn't matter what Fed does. What eventually matters is inflation, the business, the quality of a business, and what do you pay for those businesses? You made stupid mistakes in paying up for in 2021. Don't come and blame Fed. Introspect and say, where did you make a mistake? If you always keep blaming Fed, then you're never gonna learn. But yeah, you can use Fed as a punching bag. I've seen many investors, hedge funds, mutual funds, and yesterday, like listening to these VCs, they're blaming Fed now. So now, after having debunked all these things, the myth around Fed, let's talk about what Fed actually did this week. So you got a 50 basis point rate cut, which was a larger than typical. I don't even know why we did 50. But who am I to, comment or go opposite what Fed has to do. So anyway, so they started a rate cut cycle with that coincide with no recession. And I think over past many weeks, we have looked at the data. Again, history may not always repeat, but every time when Fed has cut interest rates in the past, when the economy wasn't in recession, the stock market over the next 12 months and 24 months has given positive returns. So if you are thinking that, oh, market recently hit all-time high this week, and how high can it go? History tells us that in these scenarios, market has given positive returns. Is it going to happen this year? Who knows? Because the valuations are already currently elevated because of the whole AI and all that stuff happening, right? So will we get to see the same 10%, 12% return in next year? I don't know. But historically, markets have returned positive, right? Now we are seeing the cyclical mid-cap and dividend-paying stocks are going higher because, again, market is expecting that the other, the bonds and the bill, the T-bills, the other fixed rate instruments, the rates will decrease, and hence the attractiveness of dividend-paying stocks will increase, right? And of course, when you cut down the rates, eventually the discussion is, we think that the loans will become cheaper, and hence the mid-cap companies that are in a need for business loans will start to do better. So, and now we are seeing that the mega caps, the Magnificent Seven, haven't performed as good as, let's say, the rest of the market over the last few weeks, because now they are starting to benefit, right? Bonds may continue to benefit. If the Fed reduce the interest rates, the existing bonds become more attractive. And finally, pay attention to the reinvestment risk, because right now $6 trillion is sitting in a money market fund. Now, the reinvestment risk, when you're, or if you have a CD, when the CD mature, where are you going to put that money? I mean, expectation is maybe by next year, the Fed funds rate will come down to 3% or something. So you have the reinvestment risk if the huge amount of your portfolio is allocated to cash or cash-like instruments like CDs, etc. What are you going to do? Right now, the CDs are paying 5%. Next year is going to mature. Where are you going to reinvest? So that's a reinvestment risk that you need to think about. There are $6 trillion sitting in the money market funds holding in cash. That money needs to find a new home. What else? That's all I had around Fed. I think we should. Yeah, these numbers were a little bit eye opener for me in terms of over a long term. Doesn't really matter what Fed does to the interest rates. So 1 week performance, let's look at risk is back on. Fed cutting rates, you got a license to gamble. So I see a lot of tech companies, they've recovered. Google up 4%, Meta 7%. I don't know what drove Meta. I didn't see any big news around Meta, except that they have extended the partnership with the Ray-Ban maker. Maybe I missed something. I saw one news which I'm going to talk about later, which may be a headwind to Meta in the short term, but Meta is up 7%. I don't know why. Maybe I missed something. Tesla is up 3.5%, except the chips. I think NVIDIA is, other chips were up, but not the NVIDIA. But, we had a SPY that hit new all-time high. Dow Jones hit new all-time high. Markets are hitting all-time high. Forget the stock market. Crypto market, again, a barometer for risk-taking capability. Bitcoin hit, it was up 63, more than 63K. But yesterday night when I took a screenshot, it was like almost close to 63K, 62 now. What is it? Where is it right now? Let's look at where is Bitcoin? This market trades 24/7. Oh, it's up more than 63. So risk on, baby, risk on. We got a license to gamble now. Other news around crypto is options are now been approved on IBIT. IBIT is one of the ETFs, Bitcoin ETFs. Issuer is BlackRock. So obviously Larry Fink gets what he wants. So I think we talked about it a few weeks ago, wherein the question was when the options will come out, our expectations by end of this year. So we got approval this week. So now it's up to the exchanges and the issue. I think exchanges probably gonna start listing it maybe next week itself. So IBIT it has been approved, and I think it's just a matter of time before the other issuers also have their options, the options on the Bitcoin ETF being listed. So we'll see. So that's another one, I think, a big news on the crypto side. What else? I don't have anything else on the macro. A question from Bobby: how is money market correlated to bond or Fed rates? Again, it's the same correlation that we have been assuming, that the Fed is a rate setter. When Fed will reduce the rates, all the other risk-free rates will come down, and hence the money market rates will come down. And if that happens, what do you do to your other investments? I mean, why today money market funds are paying 5%? Because our inflation was high and our Fed rates were more than 5%. So that's the reason. If the Fed rates will come down, eventually maybe all rates will follow. May not follow immediately. I mean, that discussion was around does it follow immediately in the next quarter? No, but we'll see. If Fed reduces rates, will the value of municipal bonds become low? So no, if you're holding municipal bonds, if Fed reduce the rates, the value of the bonds go higher. Because, okay, let me put it this way. Let's say if you're holding a municipal bond which is paying 5%. Now Fed has reduced the interest rates to 4%. Now those bonds are become more attractive because they are paying 5%. So the value of the bonds will go higher. So the interest and the value of the bonds, they are generally moving in inverse direction. So if we look at the 20-year TLT bond, the reason why the TLT has been beaten over last 2 years is because Fed has been increasing interest rates from almost 140s. It's been beaten down to 85. And since at the start of this year, we start to, got hint from Fed that they're going to increase the interest rates, TLT has started to move up. So interest rate and the bond prices move in opposite direction. I hope that clarifies the question, Avnish. All right, so let's move on. Any other question on interest rate or Fed rate? All right, so Year-to-date sector performance, IT is back up 27% up for the year. And this is on top of last year, I think QQQ was up what, 40%? This year, QQQ, which represent the mostly companies trading on NASDAQ, we consider them as the tech companies, is up 20%. QQQ is up 20%. Not hit its all-time high, but can't complain. Utilities number 2, this was the surprise for me for the year, and all because of the boom in power generation because of the needs of AI. We saw this week an energy company called Constellation Energy, which owns a nuclear power plant. Microsoft signed an agreement with them to restart the nuclear power plant, and it's 20 years agreement, and the stock is up like almost 30% on that news. I think there is another Vistara Energy or Victra Energy. Again, these utilities companies, I've never seen utilities outperforming S&P 500. Because these stocks don't move generally, but because of the current scenario wherein there's a need for energy, we are seeing utility sector outperforming S&P. But in any case, almost 20%, man, S&P 500, even if you have done nothing. I think before starting the show, we were discussing how like about being IQ for investing. Forget about IQ. If you just stayed invested in S&P 500, you don't need any IQ. You don't even need to read any quarterly report. You're still up 20%. Right? Can't complain. Fear and greed index tells us that we are back into the greed section. This is the time, and I want to be a little cautious. Right now I think I have the very few amount of deltas, because I was holding negative deltas. Stock went up, so I lost a lot of deltas. Well, that's fine. I'm still want to be cautious when the market is trading on the greed or extreme greed level, right? We'll get our opportunity. Don't have to get into FOMO. Haven't missed the boat. Market does provide opportunity. So portfolio. Again, this is not a recommendation, but I want to be transparent in terms of what changes that I make to my portfolio. So bunch of selling this week. Not that I really wanted to sell, but C Limited, Meta, Mercado Libre, I had to sell a few shares because I had a call spread that were in the money, and so I basically closed the call spread and sold some shares. Now that I'm bearish about this, I still hold these shares in my portfolio, but I had to sell a little bit. And SPY, I had a short call, so that got assigned to me, and now I have a short position on. I'm holding a short position on SPY. I haven't yet closed it, so basically I got a cash, and I have a negative shares of SPY. I'm still holding that, and we'll see. When I have to manage the deltas, I'll close that. She says got assigned on the shortcut in Melee. Yeah, that's the reason why I closed Melee, was because so that I don't get assigned. The bid-ask spread is generally wide, so I didn't want to get through the assignment process. That's why I closed all of these short call spreads, and then sold some shares. But SPY, the one which I got assigned on SPY is 27th of September. I wasn't expecting to get assigned, but I guess SPY is gonna declare dividend, and I missed that. And I didn't check in terms of what's extrinsic value and how much of a dividend they're paying. I guess that's the reason I got assigned. But I had these positions on 2 brokerage. On one I got assigned, another one that I'll close it. So what else? So this week, Hall of Fame, these are the stocks that hit a new 52-week high. SPY, you can check it. I don't want to go through all the 15 names, but this is our Hall of Week. And this week, Hall of Shame is BA, which is Boeing. I think last week also Boeing had a dubious distinction of being a 52-week low. Same is the case this week. Looks like I hope that all the problems that Boeing has to get happens and finishes it in 2024, and we'll get a better 2025. But this is the stock that again I hold it in my portfolio. Hasn't done well. I mean, probably I'm down like say 50% on it, but position size is fine, so I'm okay. All right, any questions on these stocks? All right, so let's move on. So now we're gonna talk about India shining, and I think I talked about this last year. The reason I want to bring up today and give you a little more update is I saw a few articles in some magazines and some newspapers around how the investment is flowing in India, both in terms of a capital investment, means investment in the Indian stock market, as well as your investment into the industries. Like Apple is setting up a new plant in India to manufacture. I think it was a Friday or Thursday, ADI, analog devices, they signed up an agreement with a Tata company. It's a conglomerate to build chips in India. So there are a lot of stuff happening. So I thought maybe I'll give you update on that. So what's happening? World is trying to decouple from China and routing those investments to India because of all the stuff that is happening. There are two. Number one is China's economy hasn't been doing that great. Right? The property sector, which is where majority of the Chinese population, have their wealth, got crushed over the last 2 3 years. Many of the builders or the Evergrande and there was another Country Garden, something like that, they all to declare bankruptcy. Some of them start to default on their bonds. So world is trying to figure out and take capital out of China, and they're looking at a new places to invest in. India is one place. I think Vietnam is also doing good, but I don't track Vietnam market. So if someone else is tracking Vietnam market, sure, tell me and you can come and talk about it. So number two, the foreign investments is declining in China. Right. Also, China has been sending some signals around to Japan and Taiwan. We are seeing more of Chinese warships and staying and entering into South China Sea water. And there's been a conflict around, could it become a war between this one? Who knows? But anyway, so the world is getting a little bit jittery around China, and the foreign investments is actually investors are pulling out of China. So the foreign investors have pulled almost $12 billion since the beginning of June 2024. So we're talking about what, 3 months, right? Now the Chinese government is not even publishing the daily data of the foreign investments, right? This reminds me of a similar stuff that we had seen regarding the unemployment situation. When the unemployment situation became really bad, Chinese government stopped publishing the data. I mean, if you don't see the data, it means everything is good. But that's not how it works. So they are not publishing the data. And foreign investment outflow is a fallout of the consistent underperformance of Chinese stocks in last 3 years. If you look at FXI, which is a large cap Chinese ETF, over last 3 years, come on. Okay, let me go to Google Finance and maybe that will do better. I don't know what happened to Thinkorswim. FXI. Last 20, yeah, haven't done much. 30, what, 35, 37. It's been declined. So look, it was from 55 last 3 years, it's down to like cut in half. Right? So I haven't been performing much. So, and if you are an investor, you need returns, which we are not getting from Chinese equities, right? Overall, maybe there are some companies in China particular that have done one, but overall, as a market, China hasn't performed. And now, most recently, MSCI, which manages a lot of these funds, they actually have the weight of China in that fund has declined from almost 39% in 2020 to 24% in August 2024. That is like 40% decline in the importance of a country in an emerging market fund like China. And India's weight has increased from 9.2% to 19.8%, almost 100% in the last 3.5 years. Right. According to Morgan Stanley, there is another index in which MSCI EM Investable Market Index. Indian stocks now have a higher weightage than the Chinese stocks. Over the last 2 decades, China's stocks always had a higher weightage in these emerging market indices, right? So the countries that we consider emerging markets are famously what we used to call BRICS, right? Brazil, Russia, China, India, and South Africa. Right. So now Russia is out. Russian market is, and South Africa is having its own challenges around the whole inflation, right? And then China, India, and Brazil used to play the major part in these emerging market index. And with China used to have the heaviest weightage, now the weightage of China has been reduced. Now let's also look at 2 ETFs, MCHI, which is MSCI's China ETF, versus INDA, which is MSCI's India ETF. Since 1993, MSCI MC ETF is returned 0.89%. This is even worse than the fixed income, whereas India ETF INDA is a annualized return of 13.5%. And if you have those managers or the foreign institutions who've been investing in China overall as an economy or as a stock market haven't made any money in China. So now they're like, okay, maybe we're moving out of China. So probably maybe China may have been a market of individual companies rather than an overall stock market. Overall stock market, again, I'm just looking at one particular ETF, MCHI. So let's look at how big is the MCHI. And this is coming from iShares, which is like a black rock. So it's not coming from any smaller issuer. $767 million, almost $1 billion under management from a BlackRock. So I think I should pay attention. So anyway, these are the reasons why foreign institution investors are now finding, okay, guys, we waited enough. China is not returning. So where do we find the money? Where do we put our money? And a lot of that money has now flown into India. And that's what you see in the performance of INDA, right, which is up 13.58%. If you look at some of the other Indian ETFs that we have discussed in some of our previous sessions, S-Min is one of them. There are a bunch of Indian ETFs that we have looked at. Some of them may have performed better than this, right? Some of them may have performed worse than this, but INDA, I think, have some of the bigger companies, and that itself has performed 14%, which is, I think, is even better than what the US market has performed. Of course, there have been some period when the US market would have done better, but looking at last 30 years, if you pull in that data, Indian market has kind of overperformed. Let me make sure. Yeah, so this is USD return. So which is, I think, the foreign currency risk is already taken care of. So what's happening in India? Market is really hot. IPO market is hot in India, even though in US, my IPO market is like Lina Khan is not letting any companies to go to IPO, right? So the M&A as well as IPO has been a little lackluster in US, where India IPO market has been really hot. So I think last week, this is a non-banking financial company, which is housing finance. IPO was oversubscribed. So let me give you a little background of how the IPO market works in India, because that was a shock when I moved to US. I'm like, I can't invest in IPO. What do you mean? Let's go to when an IPO company wants to go on IPO, they basically take out an ad, or you can see these even on your brokerage platform. They'll have an offer available for their share sale, right? And now in that offer, what I want you to pay attention to is, in the US, as a retail investor, I can't invest in IPO, right? Unless I know the broker, or maybe I have a friends with the investment bankers, right? I can't invest at the IPO price. But in India, they actually categorize the IPO to be allocated to a different category of investors. So if you look in here, you'll see they're saying qualified institutional buyer, not more than 50% of the offer, right? So let's say if you have an offer for 10 million shares, as a company, you're selling 100 million shares. 50 million max can be given to the qualified institutional buyers. Non-institutional portion, not less than 15%. Retail portion, not less than 35%. So 35% means 35 million shares have been kept for retail investors, right? And then what happens is, when you log into your brokerage platform, you identify yourself retail, because that's how you open your account, and then you bid for it. You will see the price band. So in this case, whatever this company is, the price band is from 249 rupees to 263 rupees. Okay. Now, when I was investing in India, when I was to invest in IPO, wasn't the great thing to do it, but I wasn't that intelligent then. I will pick up between 249 to 263, and let's say I'll pick up $255. And I'll say 255, I want to buy 100 shares. Right? Now, depending on the other bids that the company have received, in the retail section, I may get allocated 100 shares. I might get allocated only 50 shares. That depending on how the other person have been bidding. Right? So I don't know what logic they follow, but as a retail investor, I always had an opportunity to get the shares at the same price band and which the qualified institutional shares are getting. When I moved to US, and I thought, okay, this company going IPO, I opened my account with a Scottrade. That company doesn't exist anymore. It got bought over by TD Market. And I logged into my Scottrade and I'm like, okay, where do I buy the IPO shares? And I couldn't find a place. What the heck? How does the IPO work in US? It took me, of course, I wasn't very active. And then I didn't bother about it. It's only when I became more active and I realized, well, the IPO in US works very differently. You don't treat retail investors as on par, and I used to still think the US is the most efficient capital market, but it is not retail investor friendly. Anyway, so what happens if you have only 100 million shares, and including institutional buyers, non-institutional buyers, and retail portions, you all bid for those shares. Like I said, I bid 100 shares at 255 rupees. You might have bid 1,000 shares at some price point. So they, at the end of when all the offers are in, they figured out how much of a subscription have they received for their shares, right? And that is what defined as, either it is oversubscribed or it is undersubscribed. So in this case, let's say this whole Bajaj housing finance was oversubscribed on the first day of bidding. And this bidding remained open for a few days. I think we'll look at this particular. So it will tell you that this is open for how many days. Somewhere it should tell. Maybe I this is actually a 2-pager document. Maybe I didn't take the screenshot where it had that this bidding remain open from, I think it probably stay open for a week, right? So on the first day itself, it got oversubscribed. It had, the offering was for 708, they wanted to raise 782 million US dollars. It was oversubscribed by 64 times. IPO market right now is so hot. The Bajaj Finance IPO ran from September 9 to 11. It was open for 3 days. And 16 IPOs are open for subscription in this most recent week. And 200 companies have raised more than $7 billion in India through IPOs. And this stock was up 130% after listing. So as a retail investor, if you got, I had asked for 100 shares. If I received 50 shares, I was able to participate when it was up 130%, when it opened. I don't know when it opened, how much was it up, but when it closed, it was up 130%. So in the US, when we see the stock, when it start trading in the market, it trades up 50% higher. As a retail investor, you don't get any benefit because you don't have a stock. The investment bankers and the friends of the bankers have the stock. In India, there is some portion which is also kept for retail investors. Anyway, the reason I brought this up is the stock market in India, a lot more of a retail investors are now participating in the stock market because they're seeing a lot of wealth being generated in the stock market. Of course, they're seeing that over the last 20, 30 years, if you're not invested in the stock market, you've been left behind. And hence, we are seeing so much of I feel that this is euphoria. But, the craziness can stay in the market much longer than what I anticipate. So I won't doubt it. I want to focus on the fundamentals rather than, okay, the stock was up 130%. We see the downsides of it. India has 2 bigger exchanges, NSE and BSE. The futures contracts, the index options. India is not the biggest stock market in the world, but NSE had 97% global share of the options on indexes. That was mind-blowing for me. That across all the worlds, the number of index options that got traded, NSE had 97% share, which is what you got to be a little cautious, right? And what's happening is a lot of people are losing money. It reminds me of the same euphoria that we have seen in 2021, right? And I have my, some families and friends, they've added me into, I think yesterday I got added into a WhatsApp group and they're talking about this stock tip, that stock tip, this stock is going IPO. Hey, did you get allocation or not? Then they're looking at someone who is an asset management company, the lead manager for that offer. And they have some contact with the lead manager of that offer on, sorry, not an IPO offer, but for a private company, right? Pre-IPO companies. Folks are going crazy over there. And because market has performed, that has brought in more and more people. Right. But what I want to focus on is some new things that I've noticed on the digital stack, which India has been building. And I think I talked about these 3 layers before last year, which is basically all public digital infrastructure. Unlike in the US, in India, the whole digital infrastructure has been built. I would say that the pipeline, the plumbing of the digital infrastructure has been managed and done by the government of India because it's for public good, right? It's not done by a private company. The private company need to make money. You can't make money when you're trying to build the infrastructure. So the first one was, I guess they started in 2007 or something, ID. for everyone, online ID for everyone. Then once you have an ID, you start doing a banking operations. That brought in some 400 million new bank accounts being opened. Then came with your online payments, which we still don't. I mean, in India, Aditya is there. You can I ask him, India, you can just pay via your QR code, just like you can do it in China. Right?
Exactly.
Even
Yeah,
a street
yeah.
vendor has got it. I'm like, I can't do that in US. I need to have a card. I feel so backward when I had to go to India because, I don't have that account yet because it was not enabled for non-residents. But everyone just pays through QR code, and you don't have to go through Visa, MasterCard network fee. It's direct bank-to-bank transfer. So they built an online payment. Now the fourth one, which is what government of India is building, is a digital commerce. Means it's called online. They're building a platform. You can say US equivalent will be just like Amazon, but it's not controlled by Amazon as a company. So what government of India is building ONDC is, if I'm a provider of a service, I'm a logistics provider, I can go and register myself on ONDC. Right? You are provider of goods, right? You will register and show all your goods on ONDC. I'm a consumer, right? I want to buy goods. I pick up goods from merchant A, and then the logistics provider, shippers who are registered on ONDC can bid for who is gonna deliver to my address cheaper and the fastest. So it's a digital commerce layer that government of India is building, and I think it started like 3 years ago. It's still hasn't. I mean, these takes decades to build these things, right? But I really like the concept of it's not owned by Amazon, and as a consumer, I can shop on any merchant, and then the logistics provider will basically give competitive bids to deliver the goods to me, right? So this, I don't think I discussed this last year. Now this year, what India government also done is create something called account aggregator. In US, we have a company like Mint, which aggregate all your financial information. Monarch Money does that. MSN Money used to, Quicken used to do it. I spent a decade in a company which did this stuff. So you can do it on a Bank of America. Those are all my customers. Fidelity allow you to do this, but these are individual companies. Now, government of India has an initiative called account aggregator, wherein if I'm a financial institution, right, I can go and sign up on this platform, and then, of course, with my customer's permission, I will be able to share some of the financial data. Right? Now, what that enables is, if I'm, let's say, a loan provider, right, and I need to and so far in India, you don't have a concept. I mean, there is a equivalent agency, like we have a credit rating agencies, but you don't have a credit score in India. So how do you now figure out who to give loan to? You need to have those, old papers and all that stuff. So the processing of loans used to take days, because you need to bring in your paper bank statements, your loan, your property documents and all that. But with this digital infrastructure, wherein, your identification, your banking information, your property, that information, a lot of stuff moving online. Now with the account aggregator, the lender has a 360-degree view of your financial information, and the loan processing time has been cut like by 60%. If as a business owner, I need to go and get a loan, and right now I think there is, let's say, almost 160 financial institutions have signed up for this account aggregator. It just is in a pilot phase. But this is another area where I'm seeing that the government or the digital infrastructure space in India is advancing way faster than what I'm seeing on the US side. US, all this being maintained by private companies. But in India, the push has been by the government, and the private companies are participating because the thought process is that internet, digital commerce, etc., is a public utility. So what that has also enabled is now the taxes are all being filed online. Right? You don't email your tax returns. Oh, sorry, you don't mail your tax returns. All your now the returns are filed online, and you get your refunds, etc., everything online. So fascinating progress that I'm noticing on the digital space on India. I think maybe except China, I've not seen any other, none of the European countries or the US does actually have anything which matches their UPI in India. Now, I think this unified payment interface will also allow you to transfer money between, I think the France and India had an agreement. You can actually transfer it cross-border. I guess Singapore also has, but now they're also expanding it to allow cross-border payments very cheaply because there is no other third parties involved. Right? So that's one reason why there's optimism around the growth in India and the way the government has been enabling this whole digital stack. Now, if you look at the lot of so India traditionally, the India generally shuns credit. Right? When we were growing up, we were told that borrowing is bad, right? So the uptake of a credit in India is very less. And of course, there were no tools available to know the credit worthiness. But once this whole digital, infrastructure is in place, we should see the more uptake of a credit in India, which will enable the more of growth of different industries in India and all that. So, yeah, that's the reason why I think a lot of funds, even on the US side, have started to look at India, and they say that India is where, let's say, China was 20 years ago, 30 years ago, when we looked at China as a next investment opportunity. Similarly, now the funds are looking at India as a next investment opportunity. Okay. So that's a quick update I wanted to give you on the digital commerce and account aggregator, because I don't think I covered these two layers in our previous discussion. So I still hold, my investment in India is through the ETF, because I don't have a time to spend and study individual companies. So I just use INDA as a ETF. Any questions on India's investment thesis? And I'm also aware that Vietnam is starting to eat India's lunch in some of the sectors which were some of the industries that India was traditionally strong on. Some of the back office work. I know that the call center business was taken over by Philippines and now Vietnam. What I also heard is some of these IT outsourcing, because it's not as cheap at what it used to be in India, because the salaries in India is also increasing, is also slowly moving into other Southeast Asian countries. But then you have a different jobs that are moving on to India. That every big company across the world are setting up their global, they call it GCC, Global Competency Centers in India, right? To basically to have access to the talent at a much cheaper price than as compared to what you have it in Europe and in US, right? So while companies, especially the tech companies in US, are reducing the headcounts here, they're all going and opening offices in India and hiring over there. All right. Any questions on this?
I have a question. So I think you mentioned about the INDA ETF. So when someone invests using that ETF, do you know what sort of FX risk they have? So I imagine the investment happens gets converted into INR and then into the market?
No, so-
Basically, the question is there an FX risk when you
yes.
invest?
Yeah, so if you look at it, because INDA is like US, the performance of INDA will not be as good as, let's say, index or the Sensex of India, because the
Yes.
rupee has got devalued. So if we're trying to compare between an Indian index, which is quoted in rupees, and INDA, which is quoted in US dollars, you will not get the same performance. But
Right,
if
right.
you are comparing between INDA and, let's say, another country like FXI, which are both have foreign risk, in that case, that's an apt comparison. Because when I look at INDA, I'm like, oh, that hasn't performed as much as Sensex has performed. It is because
Exactly.
of that the currency risk. I think there. Let me just go back to and see. Is there was there an ETF which actually has that? Just give me a moment. Let me go back to look at the India thesis. Okay, let's see this. Where did we? Yeah, so we talked about all this. I did. Yeah, UPI. Okay. Where is the list of? Okay, so yeah, these are the. If you want to take a screenshot, so these are various, I think, 12 ways to play in India stock market. S-mean, EPI, GQ, GPX, and I think I did this review in terms of what are my favorite ones. I can pick up IND and S-mean, but S-mean is not optionable, so I am sticking with INDA. Yeah, okay, this is the link, right? So yeah, you can find all the ETFs which give you exposure to Indian economy and pick up, whichever you're comfortable with. Look into in terms of how they invest, what's the criteria for investing, what's the expense ratio, etc. Then if you're interested, I'll just share this on the chat. All right, so that was the portion of India, Shani. Now we just hit our 12 mark. I can hang around for 15 minutes. Let's go through some other stuff, unless there is a question. Okay.
Just an extension of what you were mentioning regarding UPI. I was just Googling this and I found that non-resident Indians apparently can open UPI and have access to making payments through those QR codes. I haven't done it yet, but apparently it's doable.
Yeah. So I think they started opening it up for different countries at different point of a time. This year, they started opening for the US residents also. In the bank on which I have account, and now that bank is also allowing it. But when I try to do online, there are still some issues. They say, hey, this number is not registered. I'm like, what are you talking about? I get all my SMS on this number. So I need to call up the call center. But yes, they have included now US into the list of the countries that if you have a US phone number, you can still make use of UPI. So
yes,
it wasn't the case in 2022 when I was in India. That time US was not in the, I think some of the Middle East country was there, but US was not one of the countries. But now US is. So if you have a US phone number, you can still use it to pay using QR code. All right, so let's look at some more options for retail investors. Apollo, which is a big PE firm, is tying up with the biggest ETF issuer, State Street, to launch a private credit ETF. How many of you are interested in private credit? Public market investing, some say boring. I want to try some new stuff, private credit or pre-IPOs and all the stuff. And if you want to do it, someone is ready to sell you some private credit ETF. And generally, it will have a higher fee than your normal index ETFs, which is, my preferred way is to trade in the public market because these are illiquid. investments, right? But the name itself, that's a private credit, means, oh, it's only for private for me. Right? Nothing like that. Why is this Apollo is now moving into launching ETF for retail participation? Do you think they love retail investors? And want to benefit retail investors? Come on. No way. Reason is they are tapped out on institutional investors. Institutional investors are not giving them more money. They're like, okay, enough. So now how do they grow? All right, let's figure out who is the next Patsy, right? Let's find out retail investors and dump these things on retail investors. Right? So yeah, the returns could be great. But if those are illiquid, if you can't get access to the return, then it's only in the papers. Right? Now I got an interesting chart which I saw in a Financial Times of EU, which shows the private equity returns. What's happening with the private equity returns? They've been declining. And when those returns are declining, you do not get able to raise the same amount of funds from institutional investors. And how do you give any return to your investors? How do you distribute the returns to investors? You need to find another source. So let's skin retail investor. Let's create an ETF. That sounds very exotic. Private credit ETF. We're going to give an exposure to retail investors. The kind of exposure that was only limited for institutional investors, so on and so forth, till date. Now we're bringing retail investors onto it. Okay, guys, you should do your own study. I get pitched for not private equity, but private credit by many presentations I've seen. Someone will ping me on LinkedIn and say, hey, we have this private credit. Here's the deck. When I go through, I'm like, not interested. You have a third-party risk. Maybe Apollo is not that you don't have much counterparty risk, but then you have illiquid investments. And if you compare over longer time horizon, they don't outperform on an aggregate level. They don't outperform S&P 500 for the amount of risk that I'm taking. So I okay, I don't want to do that. Even though how sexy it may sound, like I'm a private credit investor, I don't think it's worth taking the risk for me. So before you jump onto, these ETFs, just understand how the private credit works. ETF will give you liquidity because it will trade on exchange, right? But look at from a return profile perspective. Many of these issuers are now coming over to the retail investors because, hey, the money where they were making, they're not able to make that money anymore. So they're looking for a new cat to skin. I don't want to be that cat. Okay. That's not to say that these ETFs are doomed. I don't even know. I mean, it's not even launched, but understand what you're getting when you're getting into private credit. Okay. So that's a equivalent chart out here is investment in equities, right? 2011 to 2024, equities have done pretty well. So, of course, I think if we ignore the Bitcoin, even gold has, so where's the S&P 500? S&P 500, last 13 years have returned 13.6% annualized. Right? How much greedier do you want to be to try to, find those other exotic instruments? 13% annualized growth is humongous. It's huge. Don't be too greedy. If you held cash, then maybe you made 1%. And commodities on an aggregate haven't performed. Gold has given like 4% return on annualized basis. It is because gold, I think, had its peak in 2012. So I think it is a little bit of maybe this comparison suffer from, you picked up this wrong window for gold, because gold had its peak at 2012 and it only breached that peak back in, I think, 2023. So for 10 years, gold had done nothing. And now gold has hit a new all-time high this week. But staying on the US large cap growth S&P 500, not bad at all. And if you are more tech oriented, the tech QQQ has returned 18.2% annualized. That means your investment is doubling every 4 years. What else you need? 18% per annum is doubling for every 4 years. Right? Yeah. So again, you would see a lot more different kind of instruments being paraded on the market to the retail investors. Themed ETF, at the end of the day, it's the game of asset under management. They want to aggregate more and more assets so that they can skim the fee out of that. Same is the case with VCs, right? But why do we want to pay extra fee like 70 basis points when I can invest in S&P 500 for less than 10 basis points? And those, 0.5% make a huge difference over a longer period of time. All right, what else I have? Is the market leadership changing? When the rate cutting cycle begins from a July, like semiconductor chips haven't been performing. Chips are down 9% since the start of July. And the other companies, we were discussing when we talk about a Fed, that mid cap and the other companies, they have been outperforming the NASDAQ and the Magnificent Seven and the chip sector. So which is pretty evident from this chart. So cycle, stocks don't continue to grow to the sky, right? Nvidia is now while the rest of the market has hit all-time high, Nvidia is down to 116. Its all-time high was 140. Right? Stocks don't go to, like I said, they don't continue to go up. Now some rotation we are start to see. And why not? The earning expectation for AI is going low. So at the end of the day, the stocks need something more than the euphoria. Stock need a business also to perform. And if your earning expectation, shows us 12-month earning per share year over year. If the expectation that the average AI ETFs, looking at the constituent of this AI ETF, they're gonna grow like EPS at less than 5%, where the S&P is growing more than 5% EPS. And in the long term, I mean, it's a earnings, it's a revenue growth, it's a business growth that determines your stock price. Short term news, euphoria, that determines your stock price. What is any dividend investors here who love to invest in dividend? Nope. All right, then I can skip this. Oh, okay, Sri. So when it comes to dividend investing, of course, dividend yield and the growth in dividend is important. But I think what we would like to focus on is TSR, total shareholder return. That means it's not just the amount of dividend you're getting, but what's the capital gain or loss that you have in that stock. I bought a stock at 100. That pays me 2% dividend. Over next 10 years, I collected $20 as a dividend. What good is it for me if the stock itself has crashed from 100 to $30? Dude, I lost. So, I saw an interesting tweet. Matt Argersinger is a dividend. He works for Motley Fool and manages a dividend investing service. So he shared a list of 64 companies with dividend yields above 3%. 5-year annual dividend growth means the companies are growing the dividend of at least 10%. Right? In the world of dividends, that's like having your cake and eating it too. Right? Not only you have a good dividend yield, but the yield is also increasing 10%. So he shared, and I'll open up the sheet. So I asked him, can you also add total shareholder return? By the same logic that I gave you. I'm like, I don't want to own a share if the dividend has grown, but the share has fallen down by 70%. So he did add it. So let's see, what does this show? And this is where, as a dividend, so-called dividend investor, you have to be careful about overall returns. Right? Now, if I'm looking there, if I did not have this information, which he added late, Sirius XM Holdings looks to be a great investing. 4% dividend yield. Dividend yield has been growing 17% year over year. But even with that, you were lost 15% every year in a total, when you're computing your total returns, means the stock price plus your dividend. So as a dividend investor, if you're trying to hunt for good dividend stocks, always focus on total shareholder returns. You may make money in this column, but you might end up losing a lot more when it comes to the capital return on the shares, and hence might end up negative as a total shareholder return. And as a shareholder, what should matter to us is what's my total return. It's not like, okay, I got a huge amount of dividend, but my stock price is from $100, $10. I still lost a lot of money. Dividend is not enough to recover that. Okay. So interesting one. If you want to act, so he also shared in terms of what's the criteria he used. You want access to this sheet. This is open. So I'm going to put a link here. In case you want to invest in some companies, etc., focus on total return, not just the dividend. Okay. All right, last few minutes. Let's talk about Palantir. Then what else I have? I think I'll skip, maybe I'll skip this letter. Or let's talk about the other news. Palantir, other news. All right, no votes. I'll continue on the sequence. So thoughts on Palantir. So like I said, I think it was what, August 2021 was my first purchase. So almost 3 years as a shareholder. So Palantir recently had their AIP Con, which is their conference. So I did put up in terms of the different companies and what they are doing with their, where's that? Okay, there it is. Okay. So starting with this, the CEO's address, of course, Palantir is now part of S&P 500, which is the biggest event in the history of the one of the biggest event. Okay, so I think we survived, we became profitable, cash flow positive, and now we are included in S&P 500. I saw a lot of companies coming and talking about how they're using Palantir, Trinity Rail. What they're doing is they had issues around inventory, so they started using Palantir. Now they are like 67%. Oh, they were 67%, on time. Now their customers can believe that they're able to ship like everything on time. And the result was they saved 30 million in 3 years with only 3 months of development. So they were pretty, had a rave reviews about Palantir. Another company, Lear, their use case was capture internal shop floors issue, and record it and use it for future, basically knowledge management, which they started using Palantir. They had multiple LLM models that you can use if you're using Palantir. You can bring in Llama, you can bring in your Claude or, other LLM modules. What they found was it was very easy for them to create a system in which you can capture the shop floor ratios, and then not only it captures the issues. It also tell you how to analyze it and how to prevent those, right? This is the US government, National Geospatial Intelligence Agency. Obviously, for the security reasons, they're not going to disclose all the areas where they're going to use it, but they did talk about a couple of projects where they're using Palantir. And I think this week, Palantir signed another Maven deals. I think this week they signed 3 deals. One of them was for Maven. Mount Sinai Hospital, they saw $2.3 million annual ROI, 400% increase in the admissions per month to hospitals at home. Again, their idea was to increase the bed capacity, and they were able to add 354 new admissions. So the whole idea was which patient to be assigned to what bed and when that bed is free, and then, basically create a capacity without adding more expensive, just manage your logistics well. So in the healthcare industry, Komatsu used it for their pricing strategies. Aramark, it's a services company, supply food, cook food and all that stuff. They used to classify the data, and now model, they manually classify only 1% data. Model does 99% of the classification. The best one came from Associated Materials, right? And again, Associated Materials, like 75-year-old company, they have everything: AS400, IBM mainframe, Excel, flat files, and ERPs and all that stuff. And when they wanted to consolidate, it says consultant told us that it will take us 12 months and millions of dollars. Palantir did in 6 weeks. So the quote, I think, which is mostly quoted in the media is that if you are a Palantir everything that's in an ERP system, we are doing with Palantir. If you are an ERP seller, I'm sorry, your time is over, right? So is it going to be the next SAP? Who knows? But he had a very strong recommendations for it. For us to implement ERP across 11 factories would have taken 5 years. Palantir did it in less than 9 months. Okay. Last one is Tampa General Hospital. Again, pretty strong recommendations. They say it's helped us 300 patients from fatal infection. So they use Palantir system to monitor the patients who are suffering from who suffer from sepsis, or you could get sepsis, and they said we could save 300 patients. So actually saving lives. And their numbers were half of the national average after they implemented the system. So that's an AIP con. Aditya said there was a typo in the tweet. Instead of a bed capacity, I had a bad capacity. So thank you. Yeah. Okay. So anyway, so that's on AIP con, which I was pretty enthusiastic about it. But in any case, so this is my thoughts as a 3-year shareholder, right? Don't go and start buying shares because I am bullish about the business. But let's talk about the stock now. First of all, our team, they don't care what others think. There's a focus on building. That's the reason why they moved out of Silicon Valley, because people want to discuss politics in office. They say, we don't. VCs didn't want to fund it. Fine. I mean, it was funded by Peter Thiel. They work with the government agencies, 3-letter agencies, and that's not being looked upon, very favorably by many of the VCs of Silicon Valley. They said, fine, but we will continue to work for for enhancing Western values, to protect Western values. Boot camps is the best GTM motion. So the way how they bring customers on board is they have a 3 days of a boot camp, get together with engineers, and they actually have a functional product at the end of that boot camp, right? No PowerPoints. The CEO hate PowerPoints. He derides the other vendors and they say all they have is the PowerPoints. We actually show you the product working. Right? AIP is one of the few real application of AI delivering tangible benefits. I mean, otherwise it's like, yeah, I can create goofy pictures or text to movies. We haven't really yet seen the benefits outside of that. Copilot is one, but hasn't started to make a material impact. But here I did see customers coming and talking about it. This is the 5th edition of AIPCon, so you can go and watch previous editions. New product introduced is called Warp Speed. This is what, let's say, Tesla has done. Tesla has built every system that they use in-house. And what Warp Speed allows you to do is to build those systems which were earlier managed by all ERPs, right? So if it works out well, could it become what SAP was in its prime? Possible. 20 years ago, 15 years ago, SAP used to be one of the most valuable companies, software companies in the world. Right? So this is the new product they have announced. So I believe journey has just started and there is a lot of potential in the business. Recently joined S&P 500. We talked about it. Here's what you need to caution about. Operating margin still sucks. Right? It is trending in the right direction, but look at the margins. It is 11%. Right? It used to be negative 40%, negative 9%, 3-year average. It is trending in the right direction, but as a software company, I want to see this operating margin to the tune of 30%, 40%, right? I'm not going to bet my house unless they fix the profitability of their business, right? Large chunk of free cash flow. So you will see the CEO talking about, hey, we are free cash flow positive. But dig deeper, large chunk of the free cash flow is sponsored by stock-based compensation. If you take out the stock-based compensation, 3-year average, no free cash flow, right? Last trailing 12 months, they'll say we have a $700 million free cash flow. $500 million is sponsored by stock-based compensation, which is a real cost. I will say that's a bit eyewash. As an investor, you need to watch it for that. Balance sheet is strong. They still continue to dilute us as a shareholder. Palantir and Snap were 2 companies most notorious on the stock market for diluting their shareholders 3 years ago. Palantir heard it, and if you look at their buyback yield average, is now coming down, but still from 11% in 1 year, now it is coming down to 7%. I want to see this number less than 4%. There's still 6% dilution is still high. It has improved. Oh, sorry. Stock price currently is what? It's up more than 100%. I mentioned earlier. It is because of a lot of euphoria among the retail investors. So be careful. Right? Business numbers has not performed as much as the stock has performed. When we first reviewed it, the stock was at $6 last year. From $6, it now reached up to $37. Do I see the equivalent progress in the business, in the quality of business? No. Am I bullish about business? Yes, I'm very much bullish about business. Am I bullish about the stock price at this point of a time? Probably not that much. But am I going to sell? No. I'll just continue to sell covered calls and happy to reduce the cost basis. But I'll be very careful at this price point. A lot of euphoria is being built into the stock price. So view the business. Market might give us an opportunity to buy the business at a cheaper price point. That's when I will probably start to become more bullish. Until then, whatever is in my coffee can portfolio, I'm happy to hold it. That's my points or a feedback after 3 years as being a shareholder. There are a lot of positives. There are a lot of positives in the business. I can't find anything negative in the business. But stock price right now is too high for my liking. I could be wrong. in that case, whatever I hold in my portfolio, I'll be happy to enjoy those gains, even if I'm not adding more. That's about Palantir. With that, let's end the session here. Any other questions? I can spend another 5 minutes. Alrighty. Palantir has I think Jim Cramer says it's a cult stock. The community, retail community is as strong as in Tesla and as passionate as Tesla retail investing community. So if you're watching FinTwit or any of the, the social media, you will see a lot of, pump about Palantir. But as an investor, it is important for us to look at how the business is performing. So that's why I wanted to share my thoughts. Which Charles Schwab account or money market do I use to park my cash? So again, I just put it in ICSH. I mean, all money market kind of give a similar one. So ICSH is a 3-month T-bill. So I can just buy directly on my Thinkorswim, and I use ICSH to park it. If I have a cash sitting in the bank, then it'll be like some CD. When I move the cash into my brokerage account, but I don't find a use of that cash right now, I will have that ICSH. Have you had positive return in Palantir? Yes, I think my average cost basis, I mean, I bought the shares in 2021 at $26, $27. Then I bought it at $6, $7, $8, 12, 14. Let me just pull up. But my average cost basis is close to $13, I guess. So yeah, I have a positive return as of today on Palantir. Let me see, where's my, okay. Any other question? She said money market funds in Schwab is good one also. Yeah, I mean, I've never tried to look for, I was familiar with ICSH. I've used it earlier. So just, stayed with it. So I'm looking at my Palantir to PLT. Yeah, I think my cost price is $14, close to 14. So I bought it at 25, 27, $7, $8, 9, 11. Sorry, 17, 15. The last purchase was in March at $26, close to $26. After that, I've not bought any stock since March. Alrighty, cool. Looks like no questions. So thank you, and thank you for allowing me to have our community photo. I'll hand it over to my kid. They can use it in whatever slides they are building. Thank you very much. So like I said, next week I'll still have the meeting on. Maybe we'll cut it to half, and if you have bring some topics for discussion. I may not have a document ready. It all depends on how much time I get it, and maybe what condition we are in after the partying in the night. Alrighty, guys. Talk to you next week. Thank you for joining today.
Hey, Vivek,
Yeah.
I have a suggestion for your topic. Maybe you can go over some information, how you research and keep all your documents together, meaning, when you decided to buy and what reason and the price and all of those things, and keep track of that information added.
Okay. Yeah. That I don't have to prepare anything for that. So thank you. We can talk about that.
Sounds good.
Cool.
Thank you.
Alright. Cool.
Have a nice day.
Thank you.
Thank you.